Welcome to the deep dive. If you've been keeping an eye on crypto lately, wow, the last few days have really served up some complex signals, haven't they? Kind of contradictory, even.
Absolutely. It's moving so fast.
It really is. And cutting through all that noise, trying to figure out what's actually important, well, it feels like a full-time job sometimes.
Yeah, definitely.
But that's exactly why we're here. Okay, let's unpack this. Our mission today: to take those signals and distill them down into something clear, something useful for you. We're going deep on Bitcoin's fascinating market moves lately. Then we'll look at this really innovative and, let's be real, maybe a bit controversial crypto lending thing.
Oh yeah, that divine research story is something else.
Right. And then we'll tackle this bold new prediction that honestly could change how we think about Bitcoin's long game, its cycles. We've sifted through a lot, mostly drawing from Cointelegraph's Today's Crypto Pulse, Bitcoin, loans, and market shifts.
That source.
Yeah. The goal is to pull out the really key bits, the surprising facts, so you walk away feeling properly clued in,
Yeah.
Not just informed, but like you get it. And hey, just a quick note, if you find this valuable, hitting subscribe, leaving a comment, engaging, it genuinely helps us out big time. Supports the channel, helps with the algorithm stuff, and lets us keep making these deep dives for you.
It really does. And what's fascinating here, I think, is that these aren't just random headlines floating around. While each piece is important on its own, when you look at them together, they give you this really powerful window into the big trends shaping crypto right now. We want to go beyond just, what happened and really get into the why it matters.
Yeah.
What are the bigger implications for digital finance, for decentralized systems?
Exactly.
So this isn't just catching up. It's about giving you the tools, the insights to think critically about where crypto's headed, connecting those dots you might not have seen otherwise.
Okay, so let's dive right into the market's pulse. Bitcoin's price action. Anyone watching the charts saw Bitcoin put on quite a performance recently.
Yeah, that rebound was noticeable.
Definitely. It climbed nearly 4% after that brief dip, below $115,000 on Friday. And then it was trading back above $119,300 by Sunday.
Right.
So this recovery brings us to a really, really interesting spot on the charts, this key resistance zone. We're talking about the range between $119,000 and $120,000. So maybe for folks who aren't staring at trading screens all day, what's the big deal about this specific zone? Why is it so critical for where Bitcoin goes next in the short term? Is it just a number?
That's a great question, and it's fundamental really for understanding markets, especially crypto. A resistance zone, in technical analysis terms, is basically a price level where historically there's been enough selling interest to stop an upward trend in its tracks, or even reverse it.
Like a ceiling.
Exactly like a ceiling. A persistent one that the price just keeps bumping its head against. And it's not usually just one sharp line, it's a band, like you said, 119K to 120K in this case. Analysts like CoinAnk are calling this area strong resistance. And it's not arbitrary at all. It reflects places where maybe people who bought lower are thinking, okay, good time to take some profit, or people who bought higher are relieved to sell at break-in. So supply starts to outweigh demand right there.
Makes sense.
And the more times the level acts as resistance, the stronger it's generally seen to be.
Okay. And CoinAnk also mentioned something called dense liquidation clusters within this zone. That sounds intense.
It does sound intense, yeah. And it's super important for understanding why things can get volatile, like really suddenly. These liquidation clusters are basically price points where a whole bunch of leveraged trading positions are set to be automatically closed out.
Leveraged positions, like betting with borrowed money.
Precisely. You borrow to amplify your potential gains, but that also massively amplifies your potential losses. So if the price moves against your leveraged bet, say you bet long, and the price drops, the exchange automatically closes your position. That's a liquidation. It protects you and the exchange from bigger losses.
Got it.
Now imagine, a whole lot of these positions are clustered just above a key resistance level. If Bitcoin manages to punch through that $120K ceiling decisively, well, it triggers a cascade. All those people betting against the price going up, the short positions, get liquidated. They're forced to buy Bitcoin to close out their positions, which adds fuel to the fire, pushing the price up even faster.
Wow. And the reverse if it fails to break through.
Exactly. If it hits the ceiling and falls back, it can trigger liquidations for the long positions. People betting on the price going up, they're forced to sell, pushing the price down faster. So these clusters make that resistance zone a real potential trigger point for sharp, fast moves. High stakes, lots of money on the line right there.
Okay, that paints a much clearer picture. It's not just a ceiling, it's a potentially explosive ceiling. Now, speaking of explosive moves, That dip below 115K on Friday. Cointelegraph linked it to something specific. A huge sale, 80,000 BTC from a Satoshi-era Bitcoin whale.
Yeah, that was huge news.
I mean, 80,000 Bitcoin, that's got to be billions of dollars. What kind of impact did that actually have? And maybe more importantly, what does the market's reaction tell us?
It was absolutely a seismic event. On-chain data, Look On-Chain was tracking it, confirmed these massive movements. Galaxy Digital apparently handled the sale for a client, 80,000 BTC. I mean, that's a huge chunk of Bitcoin's typical daily volume. Sometimes it's more than the daily volume.
Wow.
And Satoshi era whale. That suggests someone who got in really early, like 2009 to 2010 early. These folks hold massive amounts. And yeah, historically, they could definitely move the market just by selling a fraction of their holdings.
You'd expect a crash, right?
You'd normally expect a much deeper, much longer price drop. Panic selling, maybe a serious downturn, especially coming from such an old, significant holder. But here's the really profound part, the thing that surprised a lot of analysts. How quickly the market soaked it all up. That immense supply shock just got absorbed. Bitcoin bounced back almost 4% pretty fast. It almost shrugged it off.
Shrugged off 80,000 BTC. How?
Well, it suggests a couple of really bullish things, actually. First, incredibly strong underlying demand. There were enough buyers, confident buyers, willing to step in at those slightly lower prices to absorb all that supply without letting the price totally crater. That's not just retail FOMO. It's just serious institutional buying, long-term holders stepping up.
Okay.
And second, it really highlights how much market liquidity and depth have grown. The ability to just process a multi-billion-dollar sale like that almost instantly. It shows Bitcoin's market infrastructure, the exchanges, the OTC desks, the derivatives markets, they've matured massively.
Yeah.
The market basically digested this huge event in real time, which is a massive vote of confidence in its robustness.
Yeah.
It's moving from being this volatile niche thing to, well, a more institutionalized asset that can handle serious capital flows.
That's a really key point, the digestion capacity, like the market saying, yeah, okay, next. So given that resilience and knowing we're bumping up against this resistance, how are smart traders positioning themselves? You mentioned the Kingfisher saying traders should brace for potentially larger price swings. What does bracing actually look like?
Yeah, the Kingfisher's advice is smart, and it shows how much more sophisticated the players are now.
Yeah.
When you approach strong resistance, especially with those liquidation clusters lurking, the potential for quick moves up or down goes way up. So bracing mostly means hedging.
Hedging, like
Yeah.
protecting your bets.
Exactly. It's risk management 101. You're trying to offset potential losses if the price moves against you. It's not about being certain which way it'll go. It's about protecting your capital from volatility. So let's say a big fund or even a savvy individual trader is holding a lot of Bitcoin, betting it'll go up a long position. As it gets close to 120K, they might hedge. Maybe they short Bitcoin futures, betting on a drop. Or they buy put options.
Put options.
Yeah, put option gives you the right, not the obligation, but the right to sell Bitcoin at a set price later. So if Bitcoin hits that $120K wall and drops hard, the profit they make on their short futures or their put options helps cushion the loss on their main Bitcoin holding.
I see.
It's about managing that exposure to sudden moves, this kind of nuanced risk management using derivatives. It tells you the market is way more mature, more professional than it was just a few years back. It's not just hodl and hope anymore.
Makes total sense. So, okay, for you listening, maybe you're not a pro trader, you're not hedging with futures. Why should you care about all this? The price wiggles, the liquidation clusters, the hedging. What's the takeaway?
That's the crucial question, right? Because it's easy to get lost in the jargon and think, this isn't for me. But even if you're not trading actively, watching how the market reacts to things like that massive whale sale is like taking its pulse. It's a barometer for overall sentiment and health.
The stress test.
A real-time stress test. When the market can absorb a huge shock like that, it tells you something powerful about the underlying demand, about how serious players view the asset's value. It's transparent. Bitcoin's response isn't managed by some central PR team. It's the raw result of global supply and demand. That resilience, that ability to bounce back from what could have been a knockout blow, signals growing maturity, robustness. It shows that even with the volatility, there's deep conviction and liquidity underneath. And that insight, that's vital if you're thinking long-term. It shows Bitcoin's capacity to weather storms and keep moving forward as a major financial asset.
That's a great way to frame it, seeing the market digest news in real time. Powerful stuff. Okay, let's completely change gears now. Pivot away from charts and whales to something totally different, but wow, equally impactful and honestly a bit mind-bending.
Uh-oh. Sounds interesting.
Here's where it gets really interesting. There's this San Francisco lender, Divine Research, and they've apparently issued around 30,000 unbacked short-term crypto loans since just December.
30,000 unbacked loans. Wow.
Yeah, and the kicker, the innovation they're using for verification is Sam Altman's World ID, the iris scanning platform.
Okay, yeah. That's definitely bold.
So the big question is, what exactly does unbacked mean here? And what are the implications, the huge implications of this kind of model?
Right. This is genuinely groundbreaking stuff. It hits on tech innovation, risk, identity, financial inclusion, all at once on a global scale.
Oh,
So unbacked here means these loans, typically small, under $1,000, paid out in USDC stablecoin.
USDC, so basically dollar value loans.
Yeah, exactly. Dollar-denominated loans using crypto rails. But the key is, the borrower doesn't put up any collateral. Nothing. No Bitcoin, no Ether. Not even traditional stuff like a car title or house deed as security. Contrast that, right? Traditional loans. Your mortgage is backed by your house. Car loan by the car. Even a lot of crypto lending requires you to lock up, say, your Bitcoin to borrow stablecoins. That way, if you default, the lender takes your collateral. Covers their risks.
Standard practice.
Pretty standard. Divine Research. They're doing unsecured lending, which in the traditional world is usually only for people with stellar credit scores, solid financial histories. But they're doing it in crypto, at scale, without traditional credit checks. It's a massive departure. Huge new risks, but also maybe huge new access for people.
Okay, that distinction is key. Unsecured, but using crypto and World ID. You mentioned the target audience. The source said they're aiming mainly at overseas borrowers underserved by traditional finance. That sounds like a lot of people. Who are we talking about, and why is this potentially such a game changer for them?
We're talking potentially hundreds of millions, maybe billions of people globally. Individuals in places where maybe traditional banks aren't accessible or where getting credit is incredibly hard because they lack formal ID or verifiable income or collateral that a bank would accept.
Right.
Think about gig workers in emerging markets, maybe small shop owners in rural areas, or just regular folks who don't have a bank account or a credit history that fits the traditional mold. The founder, Diego Estevez, put it really clearly. He said, "We're loaning to average folks like high school teachers, fruit vendors. Basically, anyone with access to the internet can get access to our funds."
Anyone with internet access.
Yeah. He calls it microfinance on steroids. Traditional microfinance helps low-income folks with small loans, but it can be slow, involve local agents, paperwork. Divine Research is taking that idea, stripping away the borders, the bureaucracy, and powering it with crypto and global digital ID. The speed, almost instant approval, sometimes the potential scale, the super low barrier to entry. That's what could be revolutionary for financial inclusion. Imagine that fruit vendor needing a quick $100 loan for inventory, getting it straight to their phone, no bank needed. That's the dream, right? Democratizing capital access.
That is a powerful vision, democratizing capital access. But the unbacked part still screams risk, right? Especially at that scale. So how does World ID fit in? How are they using iris scans to try and manage this massive risk?
And this is where it gets really interesting and also where the big debates start.
Yeah.
World ID, Altman's iris scan platform, is their main tool, as they say, to ensure users cannot open multiple accounts after defaulting.
So it's like a fraud prevention mechanism.
Essentially, yeah. The idea is even if you default on loan #1, your unique iris scan, supposedly unique globally and cryptographically secured, stops you from just signing up again with a fake name and getting loan #2. It's like a global, maybe unforgeable ID system for their lending platform. It acts as a sort of non-traditional collateral platform. Your unique identity prevents you from gaming the system repeatedly.
Okay, using biometrics as a backstop against repeat defaults.
Right. But the implications, they're huge. Using iris scans for finance. On one hand, maybe in places where getting official ID is hard or prone to fraud, World ID offers a robust universal solution. It lowers the barrier. Someone without a passport might get access. That's the potential upside.
And the downside?
Well, the privacy and security concerns are massive, especially for people in, say, Western countries, using sensitive biometric data. Critics worry about centralizing that data, potential breaches, surveillance, individual autonomy, you name it. It's a trade-off. More access and fraud prevention in some places versus potentially big privacy risks long-term. It's a bold tech experiment trying to solve a real problem, but it definitely raises some complex new questions.
High-stakes experiment, definitely, financially and ethically. So given it's unbacked, given the audience, you'd expect some risk. What are the numbers they're actually seeing? Interest rates, default rates, and how on earth do they justify that risk level?
The numbers they report are pretty stark. They really highlight the high-risk, high-reward nature and, yeah, fuel the ethical debate. Interest rates, reportedly 20% to 30%.
20 to 30%. Wow.
Yeah, significantly higher than typical bank loans, even many credit cards or secured crypto loans. It's more in the territory of like payday loans, which get a lot of criticism for potentially trapping people in debt cycle.
Okay. And the default rate?
This is the cooker. Their reported first loan default rate is around 40%.
40%. Nearly half don't pay back.
40% on the first loan, yeah. That's incredibly high compared to traditional lending. Even high-risk portfolios usually aim for single digits, maybe low teens at worst. The founder, Estevez, is quite open about it, he says directly. High interest rates compensate for these losses.
So the 60% who pay back cover the losses from the 40% who don't.
That's the economic model, basically. Bake the expected losses into the price for the successful borrowers. It's a calculated risk for them. But the big question is it sustainable? And maybe more importantly, is it ethical?
Right.
If 40% are defaulting, does that mean for nearly half the users, these loans aren't helping? They're leading to default, maybe getting blacklisted by World ID, maybe more financial distress. Are these loans really inclusion if they lead to hardship for so many? The ethics of charging those high rates, even if people have no other options? It's a really tough question. Is it access or is it potentially exploitative?
That's a really sharp point. The line between access and vulnerability. And they have one more trick up their sleeve, right? Something about world tokens being reclaimed if people default.
Yeah, that's another interesting layer. They apparently issue free world tokens to borrowers. If you repay your loan, you keep the tokens, which might gain value. If you default, Divine Research can partially reclaim those tokens.
So it's like another penalty for defaulting or an incentive to repay?
Kind of both. It creates a disincentive to default
Yeah.
because you don't just owe the loan, you also lose out on these potentially valuable tokens. It's a clever way to tie incentives into the crypto ecosystem, using the tokens almost like a non-traditional decentralized form of collateral or maybe a reputation stake. But look, it doesn't fundamentally change the core issue, right? The main model still relies on World ID for identity and those super high interest rates to cover the massive default rate. The token thing is a secondary mechanism. The big ethical and sustainability questions about 40% defaults and 20–30% interest, they're still front and center. It's pushing boundaries for sure, but the stakes are very real, very human.
So, boiling this down for you, our listener, what does this Divine Research story really signify? It feels like this fascinating, maybe even unsettling mix of tech innovation, the drive for financial inclusion, and just massive risk, all happening right on the crypto frontier.
Absolutely. And it's not just some niche startup story. This model could be a glimpse into one possible future of lending, especially globally, digitally. It shows the power of blockchain and digital ID like World ID to potentially reach billions who are locked out of traditional banking. It forces us to rethink credit scoring when traditional data just isn't there. So for you, it's understanding that financial innovation isn't just Wall Street anymore. It's global, grassroots, driven by new tech.
But with major caveats.
Major caveats. It forces us, as a society, to ask tough questions. How do you balance the desire for inclusion with interest rates that look predatory and default rates that suggest many are being harmed? What about regulation? How do you regulate this across borders with no physical collateral, just an iris scan? There are no easy answers. This experiment is walking a really complex ethical tightrope, and that balancing act is going to define a lot of the DeFi debate going forward.
Wow. Yeah, that Divine Research story is definitely one to watch. Shows how crypto can empower, but also potentially create new problems. Okay, let's shift gears again. Big picture time. Moving from the immediate market and lending innovation to a really provocative long-term view on Bitcoin.
Okay, changing altitude.
Yeah. Matt Hugin, the chief investment officer at Bitwise, he made a pretty bold prediction recently. He thinks Bitcoin could see significant upside in 2026. But maybe even more controversial, he claims the traditional 4-year market cycle for Bitcoin is dead.
Dead. That's a strong word in the crypto space. Yeah.
Right. So for anyone maybe not super familiar, what exactly is this 4-year cycle everyone talks about? And why would an expert like Hugin just declare it dead? That feels like tearing up the old playbook.
It really is a big claim. It's definitely stirring debate. The traditional 4-year halving cycle is this pattern, this rhythm, that's basically been Bitcoin 101 for over a decade. About every 4 years, the amount of new Bitcoin created gets cut in half. It's called the halving. baked into the code.
Program scarcity.
Exactly. Ensures the fixed supply of 21 million coins.
Mm-hmm.
And historically, these halvings have come before major bull runs. Usually, Bitcoin hits new all-time highs maybe 12 to 18 months after a halving. The whole market seemed to dance to this 4-year peaks and troughs aligning with it. The theory was, cut the new supply, demand stays the same or grows, price goes boom, supply shock.
The classic narrative.
The absolute classic narrative. It drove sentiment, investment strategies, everything. But Hugin's saying, nope, that cycle as the main predictor. It's dead. He actually said in an X video, I bet 2026 is an up year. I broadly think we're in for a good few years. He thinks the past predictive power of the halving cycle is fading. Bitcoin's price will be driven more by other, broader stuff now?
So, not that the halving doesn't matter at all, but its influence is shrinking?
Precisely. He's not saying it's irrelevant, just that its relative importance as the main driver is diminishing. And he gives a couple of key reasons why.
Okay, I need to hear this. Why would the halving, this core Bitcoin feature, become less important? What's supposedly taking its place?
So his first point is that the halving itself becomes half as important every 4 years. Now, he doesn't mean the supply cut is smaller percentage-wise each time it's always 50%. He means its relative impact on the overall market gets smaller as Bitcoin's total value, its market cap, grows.
Scale matter.
Exactly. Think back to the early days. Bitcoin market cap in the millions, maybe billions. Having the new supply was a massive deal because that new supply was a big chunk of the total coins available, a big chunk of daily trading, like dropping a big rock in a small pond, huge ripples. But now, Bitcoin's market cap is in the trillions. We've got huge institutional players, the spot ETFs pouring in money. The reduction in new supply from the halving, while still there, is just a smaller drop in a much, much bigger ocean of existing Bitcoin being traded. Institutional flows, derivatives.
The ocean analogy makes sense. The same event has less impact in a bigger system.
Right. The bigger currents like institutional demand just overshadow the ripple from the halving now. His second big reason ties into that. The wider macroeconomic environment, especially interest rates, is becoming way more dominant than the internal halving mechanic.
Macro taking over.
That's the argument. Bitcoin used to kind of live in its own world, driven by its own code and crypto narratives. But as it gets bigger, it gets integrated into mainstream finance, it starts acting more like other major assets, think tech stocks, maybe gold, gets influenced by global economic trends.
And lower interest rates are generally good for assets like Bitcoin.
Generally, yeah. When interest rates are low, your safe investments, government bonds, savings accounts don't pay much. So investors look for higher potential returns elsewhere, even if it means more risk. Money flows out of safe, low-yield stuff and into riskier assets like Bitcoin, pushing prices up. High rates do the opposite, make safe assets look better, pull money away from risk.
Okay, and connecting this to current events, the source mentioned Trump pushing Jerome Powell, the Fed chair, to cut rates. How does that political angle fit into Hugin's theory? Is Bitcoin now subject to, like, presidential tweets?
Well, it perfectly illustrates Hugin's point about macro and politics mattering more now. Political pressure on the Fed about rates is a major macro factor. Whether the Fed acts on it or not, the possibility influences markets. If that pressure did lead to rate cuts, looser money, it would directly support Hugin's idea of a positive interest rate cycle, boosting crypto.
Right.
Rate cuts make borrowing cheaper, maybe stimulate the economy, but definitely make safe investments less appealing. That could push even more money into alternatives like Bitcoin. So you've got the halving, maybe reducing internal supply pressure a bit, but you've potentially got massive external demand pressure coming from global monetary policy changes.
Yeah.
This external force could easily outweigh the internal one, especially with big institutions now involved. We're super sensitive to macro signals.
So Bitcoin's growing up, maybe? Becoming part of the bigger financial system, warts and all?
That's one way to look at it, moving from being the outsider rebel to being influenced by and influencing the global establishment, which brings a whole new set of rules and dynamics.
But, like you said, Hugin's view isn't the only one. The source clearly states analysts are divided. Some still think Bitcoin will follow the old pattern, peak soon. So it's not a done deal, this dead cycle idea. What's the case for the cycle still being alive and kicking?
Oh, absolutely not a done deal. It's a hot debate. Many analysts are sticking to their guns, believing the cycle is still the main show, maybe just delayed a bit this time. They expect a peak in the coming months following the recent halving. Their arguments usually boil down to a few things.
Okay, like what?
First, history. You just can't ignore it. Every single halving before this one, 2012, 2016, 2020, was followed by a new all-time high within about 12 to 18 months. It's a decade-plus pattern. super consistent. Many think human psychology, triggered by that scarcity narrative of the halving, just repeats itself. Accumulation, euphoria, correction, repeat, regardless of macro.
The pattern is the pattern.
Pretty much. Second, the supply mechanics still matter. Okay, maybe the percentage cut is smaller relative to the whole market, but reducing the absolute amount of new Bitcoin hitting the market every day, that's still significant. It directly impacts miners, who often have to sell to cover costs. Less selling pressure from miners can still be a big bullish push. Think about the stock-to-flow model proponents. They argue Bitcoin's programmed scarcity is its core value driver, like gold. Macro might influence the edges, but the core driver is the halving.
Okay, so history and the fundamental supply cut. Anything else?
Yeah, there's also the idea of diminishing returns, but not a dead cycle. Some analysts kind of split the difference. They agree maybe the post-halving price explosion won't be as massive as before. The percentage gains might get smaller each cycle as the market matures. But the cyclical nature itself persists. The halving still creates that unique psychological anchor, that fundamental supply squeeze that no other asset really has in the same programmed way. It keeps Bitcoin's rhythm unique, even if the amplitude changes.
Okay, that makes sense too. Diminishing but still present. So for you listening, this raises a big question, right? How do you make sense of these two opposing views? You've got strong arguments saying the cycle's dead, strong arguments saying it's alive. It's tempting to just pick one, but maybe that's not the right way.
Exactly. It's not about finding the right answer today. It's about understanding the different ways smart people are analyzing this complex market. Both sides have valid points. The real takeaway for you is to think critically. Is Bitcoin fundamentally changing? Is it becoming more tied to global economics than its own internal code? If yes, what does that mean for its role as, say, a decentralized hedge? Does it just become another tech stock moving with the NASDAQ? Or does it keep some unique character? It's about acknowledging the market is evolving. What worked in the early retail-dominated days might be different now with institutions and ETFs involved. Maybe the best approach is to see both forces, the internal halving and the external macro environment, influencing things now, interacting in new ways, understanding both perspectives, how they might work together or against each other. That's how you form a truly informed view. It's a fascinating puzzle, really, about the future of money itself. Hashtag tech check outro.
Wow, okay, what a deep dive that was. We started with Bitcoin battling it out at that crucial resistance level, saw how the market just soaked up that massive whale sale.
Yeah, the resilience was pretty remarkable.
Totally. Then we jumped into that wild world of Divine Research's unbacked crypto microloans. Innovation meets really high risk and some deep ethical questions there.
Definitely a double-edged sword.
And we finished with this huge question about Bitcoin's future. Is that classic four-year cycle actually dead because global economics are taking over?
A debate that's far from over.
So we've seen Bitcoin at this critical 119K, 120K point, showing surprising strength. We've seen these radical new lending models trying to reach the unbanked, but facing huge default rates and ethical hurdles using tech like World ID. And we've wrestled with whether Bitcoin's old rhythms are giving way to macro forces like interest rates and politics. So what does this all mean for you?
I think it means really appreciating just how complex this crypto world is now. It's this mix of market technicals, bleeding-edge tech, real social impact, and these huge global economic tides all crashing together. And you connect all those dots, the bigger picture that emerges is one of constant tension, constant evolution. You see it everywhere. Tension between decentralization and centralization. World ID offers universal ID, but raises centralization concerns.
Right.
Tension between Bitcoin as a speculative asset versus a real-world tool, the store of value swayed by Fed policy, while microloans try to make crypto a utility for the masses, risks and all. And that tension between history and the future, challenging those long-held beliefs about Bitcoin cycles as it grows up and joins the global financial stage.
So where does that leave us?
Well, it leaves us with a really powerful thought, something for you to chew on. As Bitcoin maybe does shed that four-year cycle skin and gets tangled up in global finance, what will be the new fundamental things driving its value? And maybe even more profoundly, how will innovations like these risky, unbacked microloans actually change access to finance around the world, especially for people who've always been excluded, even with all the risks and ethical debates? The questions are way bigger than just price charts now. They're about the future of money, identity, and access in our increasingly digital world. Thanks for joining us on this deep dive today.